Hello everybody, let's go over a debrief. So here is a trade that I actually did really poorly in, but one of the trades where I learned a lot. Now, my learnings were all about risk management, so that's where we're sort of going to focus here. Now, this trade was in the S&P EMINI futures on Wednesday the 29th of June. Now, if we just scroll to the profiles, we're going to be able to see the setup and what I was thinking. So what happened was we had this really elongated offer, cash value right down at the lows, and then in the overnight session you can see this profile is around those lows. Now, in the cash session, the market opened, it offered, it failed below the overnight low, and then it went bid. Now, I thought that bid was an opportunity to play for the break of the overnight high. Now, that's what I was thinking. Now, not only that, but the overnight high was an iceberg, so I thought there were really good odds on that getting taken. So what happened? We had this overnight high, cash opened. We got an offer, we false broke the overnight low, and then the market went bid. I was like, great, this is a perfect opportunity to buy. I think I tried to get long somewhere in here, and then I used some of these failures down here also to get long. Now, this high, this iceberg, I thought it would break. But what happened is the first time the market went there, it got absorbed. There was quite a lot of selling coming in below it, and then the market went off it again, and we just got this back and forth, back and forth. Every time the market got back up near the highs, you can see it never actually touched it again. And every time I got there, the price action was quite balanced or really being sold. And I balanced, I mean, lots of buying, but also lots of selling here. So it was like kind of intense balance. Now, the trade management risk reward part, which is so key here. So what I was thinking is, I thought this really should break, and I thought, okay, my short ticks are for this market to go through here. And so what I was doing was I was positioning down here, and when I saw a good flow, I would add to that position looking for the break. Now, how far did I really think this trade could go? Well, I thought it could break the iceberg and give us some stops on the other side, but I didn't really know if the market had, much more than that to the upside. So basically what I was doing was buying where there was amazing risk reward, and then adding when the risk reward was really poor, looking to risk the whole trade basically for a few extra ticks. Now, if you think about it in a different way, when I was adding, I was really doing this. I was really taking this much risk for that much reward. However, what I should have been doing was taking all of the risk down here on, much better, sort of more passive access. And then as the market came up, I could have been scaling out into the highs, because that would have basically meant that this was reward and then sort of this was risk. And that makes a lot more sense. So basically you'd be leaving a little bit on the other side. So you're leaving a few handles worth of ticks. But your risk reward profile has changed. Sort of from here when you add, it's kind of like maybe 2 to 1, where if you're taking it out at the highs, it might be sort of like 8 lots of risk to sort of, 8 lots of reward to sort of 3 lots of risk, or something like that, or 2, depending on, how you can find your access. So, just that way of thinking about this changes. And also the fact sort of the longer the market spends here, the more obvious and kind of like traded it gets, and the more people that are getting trapped trying to play for the break, that the market sort of rolls over and it can't do it. And you can see for the rest of the session, the cash session, which goes down to here, it wasn't really able to challenge those highs. So it was quite an interesting day. Then if we just look briefly at the footprint, you can see here that the market, after failing at the lows, the overnight lows, came to the highs, got absorbed. And it's just all these times it comes down here and you get this big absorption here after people who are trapped at the highs sell out, and then buyers step back in. That's a great place to get long. Again, sort of similar thing happens here. And then you can see when this market's struggling to break it, you get this sort of change in personality, and then you get this offer here, and just the structure and how sort of like thick and much selling went into this, as this market offered, was a bit of a personality shift, in which case probably the idea of breaking this this iceberg should end there. Yeah, so anyway, this was really just a good, interesting, thought experiment afterwards about, where your risk reward is, and just thinking that just because maybe you see something as really likely to break doesn't mean that the risk reward of trying to play a trade right below it is a good thing. If you think something's really likely to break, maybe your risk reward is better off trying to find an earlier entry and then using that to play towards that structure and getting out near it or scaling out into it, through it, as a better way of controlling your risk and sort of adding a bit more depth to your trading. So anyway, a little something to think about there. Now, if you found this interesting and you want to learn a bit more about footprints or say like icebergs and things like that, any price ladder techniques, how you can use bits of absorption to get long for trades, then go and check out elitetraderworkshop.com. These are all things we do a lot of here at Axia, so we're the perfect people to teach that to you if that's what you'd like to learn. And follow us on all your favorite social media, so like and subscribe and keep up with everything that we're putting out. Right, that's it for today. I'll catch you all again soon. Have a great week trading.